shine are attorneys for the injured, focused on justice since 1971.
Interest rates begin edging up in May, and that's good news for savers because rates on money market funds and certificate bonds of deposits, I should say, the CDs, should begin increasing. But what about the retirees who depend on the income from their investments? Jim Nolte from Wells Fargo here to explain. So, Jim, is the bond market a safe place today?
Well, generally speaking, the bond market is considered to be more conservative and more stable than the stock market. That certainly wasn't the case in May and June, where we saw a whole lot of volatility. Basically, interest rates and bond markets have an inverse relationship. It's like a teeter-totter. When interest rates decline, bond prices go up. When interest rates go up, bond market prices decline. If we look back in time, we'll notice in the U.S. that interest rates peaked back in the early 80s. That's when we saw CD rates at 15% plus. Well, they probably bottomed out this year in 2013 when we saw CD rates yield 0.5% or even less, and that was hard on investors. We saw interest rates begin to increase a bit after a speech by Ben Bernanke, who's the Federal Reserve Chairman, when he said that the federal government may begin to ease back on their economic stimulus program. As a matter of fact, he said that they would taper off the bond buying program. Now, reporters instantly said this was Ben Bernanke's taper tantrum, and we saw a sharp drop in the bond market. As a matter of fact, U.S. Treasuries dropped 6% in just about 6 weeks. Conservative investors were not happy with this drop in value. As a matter of fact, I think investors were pretty disappointed when they looked at their June statements. So where do we go from here? First, I think, generally speaking,